Hey guys, welcome to Aetherium Capital. Today I'll be talking about the 3 investment mistakes that I have made in my 3 years as someone who is managing a $550,000 long-term portfolio. Okay, so first let's move on to our mistake number one. I actually invested in this company called Mulan Automotive at around 2023. And if you guys look at the price over here, you may be astounded. $152 million for a stock. How can that be? And the reason for this extremely high price is because of something that's known as a stock split. So what it does is basically it increases the number of shares in the company and the market cap remains the same. So what essentially it means is that it's basically increasing the price of the stock that you have in the past, and it literally leads to such high numbers over here. So I actually lost around 50% of my investment in Mulan, and at that point in time, honestly, I did not know the reason why I invested in Mulan. This was back when I just started, and my thought was, oh, it's down, it can't go down further. So this is a common thing that people will think, oh, it's already at $1 at the point in time when I bought it. Oh, it's at $1, it can't go lower. But you have to think that $1 going to 50 cents is still you losing 50%. So a stock going from 1,000 to 500 is exactly the same as a stock going from $1 to 50 cents. You will still be losing the same percentage and the same amount of money. So this is my mistake number one for Mulan. And Mulan is one of those companies that are poor quality companies that have negative free cash flow and an extremely terrible business. So now let's move on to Warren Buffett and his opinions on why it's important to buy quality companies instead of poor companies at fair value.
By Buffett standards, is a good business, and then go into why does the car dealership business look like a good business to you?
A good business is the one that earns a high rate of return on tangible assets.
Very simple.
That's pretty simple, yeah. And the very best businesses are the ones that earn a high rate of return on tangible assets and grow. But even ones that don't grow, if they earn a high return on tangible assets, and then of course if you don't pay too much, they can be a good investment. They're a good business to start with by the high returns. If you pay too much for them, you can turn a good business into a bad investment. But if you pay an appropriate price, you can do all right. Now, the big mistake which we made in the early years was to try and buy a bad business at a really cheap price. And it took me about 20 or 30 years to figure out that wasn't a good idea.
Okay, so basically what Buffett said in this is that it is extremely important to buy companies that have a high return on tangible equity. So for those of you guys who have no idea what ROTE is, it's basically the exact same as ROIC. So what he looks for is for companies with a high return on invested capital as well as good growth. And this is actually what made Apple into the most valuable company in the world over the past 3-4 years. So now let's move on to my lesson number 2. Lesson number 2 is over here, my TMF. For those of you guys who have no idea what TMF is, it is basically tracking the stock price of TLT, which is a 20-year treasury bond. So my investment thesis at that point in time was like everyone else's. I thought that interest rates would actually be coming down. So I actually invested in TMF at around June in 2023. And obviously I lost around 40% in this stock over here. So my investment thesis at that point in time was simply that interest rates were too high and that the Fed, Jerome Powell, is going to cut down interest rates because at that point in time, they were pricing in 5 to 6 rate cuts in 2024. Obviously, as we now know in hindsight, that did not happen. So one of the biggest things that I learned from this is that we should not try to predict the macroeconomic outlook, and we should instead focus on the business quality. So this is definitely a mistake that I have taken lesson 2. And let's look at the reason why we should never bet on macroeconomic forecasts by Warren Buffett.
Charlie and I don't pay any attention to macro forecasts. We have worked together now for 54 years, and I can't think of a time when we made a decision on a stock or on a company where a macro discussion where we've talked about macro and we don't know what things are going to look like in any precise way. And incidentally, naturally we think if we don't know, nobody else knows. That's a little conceit that we have. And so we, why spend time talking about something you really don't know anything about? I mean, people do it all the time, but it's not very productive. So we talk about the businesses, and I like Bill Gross. Sounds like Lloyd Benson, back in he's a friend of mine. But it doesn't make any difference to me what he thinks about the future. It doesn't make any difference to me, what any economist thinks about it. I have a general feeling that America will continue to work well. And I don't, that throughout my adult lifetime and before that, there's always been all kinds of opinions that, about what's going to happen this year, next year, anything like that, and nobody knows. What you do know, with a very high degree of certainty in my view, is that the NSF will be carrying more carloads 10 years from now, 20 years from now, that there will be no substitute for the service that they provide, that there will be two important railroads in the West and two important railroads in the East.
Okay, so basically what Buffett said in here is that macroeconomic, even the best macroeconomic forecasters, they are always getting it wrong. So what makes you think that you are able to know it? So there's another character or another investor that's called Howard Marks, and basically he said that macroeconomics is extremely important, but it is not knowable. So as investors, what we should consider is something that is important and knowable, that we are able to actually find out and predict with some research. However, even though the macroeconomic environment is extremely important, it is not knowable, as even economists who spend their whole life trying to research on predict the future will not be able to get it right. So what makes you think that you will be able to get it right? So this was a lesson that I definitely learned, and I'm definitely staying away from making macro forecasts and macro bets in the future.
Charlie and I don't pay any.
Let's move on to number 3. Mistake number 3 is Tesla. So one of the things that I would like to caveat is that I still do own Tesla right now. I bought Tesla extremely early. I bought it at December 2023 at around $150. And of course, based on the current prices now, I have more than doubled my money. Currently, I have around $50,000 in Tesla after selling about 30% of my position. And honestly, Tesla, I would say it is a happy mistake. So why do I say it is a mistake even though I have made a tremendous amount of money on Tesla? Well, first of all, knowing what I do know now, Tesla is not a company that I would invest in because it violates a lot of my principles. It is a company that is trading at an extremely high valuation. It is a company that does not trade on fundamentals and instead trades on sentiments and hopes of the future, which is not the type of investing style that I personally adhere to. So even though I did make quite a lot of money on Tesla, well over $60,000 on Tesla, it is not something that I am extremely proud of. And I believe that Tesla is actually a mistake. And even though I believe that Elon Musk is a visionary leader that would do well in the future, Tesla is not a company that I would gladly enter again. And I will just hold the shares that I have and just ride it. And when the valuation makes no sense at all, I would be planning to sell my Tesla stake. So now let's look at some questions you guys have asked me. First of all, Zev asked SoFi. So SoFi is a company that I actually did invest in, and it's a funny story. Back when Biden was president, he actually stopped the student loan forgiveness program. And when I heard this news, I immediately bought SoFi. I forgot the price that I entered in. I still do own it now, but it's a small percentage. I am up around 200% on SoFi, or 100+% on SoFi. And the main reason why SoFi actually went bankrupt, right, is because Biden introduced a government policy that forgave the students on their loans. So what it means is that the students don't have to pay back their loans. And SoFi, which is someone that actually loaned out a lot of money to students as student debt, actually suffered immensely, and they actually went bankrupt. So SoFi is a company that, for me personally, I wouldn't touch because it's extremely unstable. It is not a company that I actually see a durable competitive advantage in. So for me personally, I won't invest in SoFi. Now, SOXL, for those of you guys who have no idea what SOXL is, it is basically, if I remember correctly, it is a leveraged ETF on the semiconductor space. So SOXL basically tracks your Nvidia, tracks your AMD, etc. And for me personally, I'm not invested in any of these companies because I believe that the semicon capital expenditures by the hyperscalers currently are slightly too overextended. And for me personally, I would rather be buying into companies that have depressed earnings instead of elevated earnings, such as now. Okay, UiPath, this company is obviously famous because of Kathy Wood. Kathy Wood invested and lost a lot of money in UiPath. For me personally, again, it is a company that is not cash flow positive. It is not making money at all, and I do not really like to invest in this type of turnaround plays. And as Katie Wood says, it's like destructive. And it is her style of investing is not something that really appeals to me. Now let's look at Qubits. So Qubits, if I remember correctly, it is a quantum stock. So basically, after Google releases its Willow and Microsoft releasing its marijuana chips, what happens is quantum stocks have now become all the rage. So again, Qubits, it is not a company that I invest in because first of all, it's cash flow negative. I do not really like it. I don't understand it. And I believe that quantum computing would take quite a while for them to be able to monetize the systems that they build. So for me personally, Qubits is not something that I'm interested in. New Holdings, quite interesting. It is a regulatory bank in Brazil. And for me personally, anything that's related to banks, I'm not touching. So I think that there's a lot of things that could go wrong when you invest in banks. First of all, you have no idea how leveraged they are. They are not willing to disclose that information. You don't know what are the things that they are underwriting, what loans they are giving, etc., and what is the risk that they are undertaking. Furthermore, it is in a regulatory country that I am not familiar with, Brazil. In order to invest in the company, I would have to read up on the laws of the company, laws of the country, which I am not familiar with. So New Holdings is outside my circle of competence. I would not be willing to invest in it. So Jason, if you have $10,000, how will you split your funds to have a fully covered stock purchase and the portfolio will be your DCA portfolio for the next 5 years? So there are multiple ways you could do that. You could invest in an ETF, for example, the VOO or your CSPX. As Singaporeans, I would recommend you guys to invest in the CSPX instead because we will have a 30% withholding tax because we do not have access to what is known as a tax treaty between the US and Singapore. So what you could do is invest in CSPX, which is Ireland domiciled. So what it basically means is that instead of the dividends being taxed 30%, it will be taxed around 15% instead. So I would recommend you to actually dollar cost average into that ETF. So of course, currently because the US market is quite overheated, I believe that it is also prudent for you to invest in other countries, for example, China as well. China currently, there are some stocks that are extremely interesting with extremely good fundamentals that are potentially undervalued. Now, Joel, Baba. So for Baba, I have been looking into it. I really like their retail side of the business. Their Taobao, their Tmall, and their QQ, etc. are extremely good businesses. And they are actually the cash cow for Baba. So Baba now has an interesting story. And the story is that AI in China will be heavily dependent on Baba's cloud as well as the facilities that Baba built out. They are spending a shit ton of money to build out the data centers for AI capacity, which could benefit Baba if there's an increasing adoption of AI in China. So personally for me, Baba, there is considerable risk, and I did own Baba. I actually owned Baba at $70 and I sold it at around $138 because of valuation concerns. So I'm certain that you guys know there are certain influencers such as AK. He's buying into Baba. For me personally, I don't really see the vision of it. I do think that Baba is a good company, but I think that is actually investing outside its circle of competence in the retail sector. So that's one of the reasons why I actually sold out of Baba. If Baba goes down in price to around $100, I may be interested in buying back my shares, but it would not be a large position because I am uncertain on its outlook. Now, Jason, on Intuitive Surgical, this company, I honestly can't really comment much on it because it is in a medical apparatus space, in the medical apparatus sector. I really don't know much about it, so I can't comment about it. Baba, yep, talked about it. How does that change for 50K and 100K? Honestly, it doesn't really change. You have to think investing in percentage terms. And if you think it in percentage terms, it will make your life much easier. Now, NVTS, this one I'll have to get back to you guys. For CVS Health, this is a company that is also down recently because of United Health is also in the healthcare insurance business. I did look at CVS Health before, and I believe that, in my opinion, United Health is a way better company based on the fundamentals as well as the margins compared to CVS Health. So for me personally, if I had to choose between United Health, especially at the valuation currently, as well as CVS, I would definitely pick United Health, even though there is a potential risk that they may be actually fraudulent. So I hope you guys enjoyed this video, and if you did, do consider subscribing to YouTube, and see you guys in the next one.